How are you today, buddy? Just waiting to hear your voice, and maybe you want to do a screen share as well. We hear you.
I can hear you. Can you hear me? I can hear you.
Perfect. Yeah, I can hear you, Alan. How are you?
Don't ask me. I have no idea. I know it's so professional. I understand.
Oh,
I gave up professional a long time ago.
Oh, you know, Alan, you should have seen me the first day Blake and Steve had me in the go-to-meeting room. So, you know, I understand, you know, you and I had to be dragged kicking and screaming into the 21st century. So great to have you. Nice to have you here.
I'm glad everything works. I'm glad we didn't lose all of the people listening in. So.
Are you going to be sharing a screen? You have that option if you want. Otherwise,
Sure.
We could just do an audio.
No, I will share my screen if you'd like me to.
Okay, let me turn my volume up. Maybe you could get a little closer.
Guy talking about the euro, so it really has no value.
All right, so before we get to the markets, Alan, how does it look for ASU this year?
ASU, well, it's always good. I think partying will be at an all-time high on ASU.
Do you go to their games?
No, I don't go to their games, but I have 2 ASU graduates in my home here.
Okay. So, buddy, here we are at all-time highs, new administration. Last time I talked to you, in fact, I'm going to pull the S&P up and show my screen. I don't know if you're going to show yours. I don't see it.
It says, when ready, please close confidential windows. When ready, show my screen. I'm ready.
Okay.
So it says show screen, so am I doing something wrong and not showing mine?
Okay, so let's see. Is your screen up? Your screen's not up?
Hey, Dale, there it is.
Okay. Okay, so you know when we were talking, Alan, last time it was 1,800 S&Ps. And it was, I think, a year and a half ago in January, while the market was under pressure and people like me thought we were entering a bear market phase at 1,800, you were sanguine. And I said something like, you know, people are afraid to miss it. And you said there's really nothing to miss. You have to give it time to see if it evolves into it. And you were dead on. So with everything that's happening now, I see you're showing Euro USD. What's your view here?
My view is that the white line that shall not be passed maybe in the next 5 years.
You're looking for 123 and 23.
So much resistance up here. I mean, that's my feeling. Not only about the euro, about currencies, is that everything, all the waves and all the time frames are just subdividing and subdividing and subdividing. That's the problem with the equity market right now. Is we keep getting, instead of getting clean trends, where it looks like an encephalograph or EKG, where you get a spike and then and the volatility sucked out, and you get a spike and volatility sucked out. Look at gold, another market that's subdividing like crazy. It's because in the 8th or 9th year of economic expansion, that's what we've come down to. We've come down to a bunch of quants going in and churning the market around. Forex is a much more honest market, I think, now than the U.S. equity market. The U.S. equity market is just
that's interesting.
Completely managed. It's like a one managed account with one gigantic investor, and all the quants playing off of that. And it's starting to blow up on them. But we don't know if it's going to blow up on them this year or 10 years from now. Sooner or later, there's going to be a huge break, and that break's going to be when quant money turns out to be the dumb money, and algo's the dumb money, because it's not. You know, we at home guys, we're just real minor players in what's going on right now, and you've got the big big players. You know, you've got the advance of the billionaires going on in the world right at the moment, and the equity markets and all the markets are really their private piggy banks. And they're piggy banks through the quant funds and through the gaming of the system, the gaming of the structure of the system, as opposed to supply and demand. So I get very frustrated with the U.S. equity market. I mean, if you're sitting here watching this every day, you'll get a little bit of supply and demand, and then the rest of the day, it's like they already know what the final number is, and they're just managing it to the final number. I would like to know Friday's closing price the prior Sunday, because I think somebody does. I mean, it's just my own sort of cynicism about it, you know. And not that structurally it still works very well for traders, because Fibonacci works and Elliott wave works and Gann works, because you can't remove the structural element of price movement. What you can screw around with is the auction place, because it's a very unemotional environment, right? So it's very hard for many traders to adapt to that. I think in all markets. I like Forex from the standpoint of it's sort of very instant karma. It's not like you're going to get a reaction to something because you have so many players worldwide. Well, here with equities, we don't really have that many players anymore. We have something like, somebody estimated that the humans only take up 10 to 15% of all market volume right now in the U.S. equity market. So we're not big players. We're there trying to game what others are gaming and ride their coattails. That's the best we can do. And we use TA to do that. We use our Elliott wave to do that. And it's a viable strategy. It's a very hard strategy for me to teach someone, especially someone who's reading through all the classic TA books, especially someone who's probably read my stuff or attended Blake's stuff for the last two decades, because we don't necessarily think the same way. We've had to adapt, almost continuously to the rise of the computer programs, and that's changed the nature of it. For example, if we get one of these big wide red NASDAQ 100 bars, we all know that you don't step in front of that. So then you've got this just burst of illiquidity that goes on for 3-4 hours, where it just piles on. Some people go short. I choose to go back to the sidelines, because once set into motion, those programs are just relentless. The flip side of it is, I would naturally go, well, listen, when that thing gets to support, I want to buy it, but I've learned that if I try to buy something like that in the last 2 hours of the market day, I'm just going to get crushed. You can buy the last 2 minutes of the market day, but you can't buy the last 2 hours of the market day on a time.
Yeah, last week's a great example with that sell-off into Friday, and you had some stabilization Friday, but unless you had your attitude, there was no way you expected Monday.
Yeah, what's the, if you take a look at the cues, nothing's happened since the beginning of June. Nothing. Yet you'll keep talking about market at all-time highs, FANG stocks. Nothing's happened in 3 months. Nothing's happened. So it's a combination of, I wouldn't call it misdirection. It's a combination of people form-fitting, because I see the uptrend. The uptrend's easy to see. And it's also a combination of Wall Street wanting to keep the excitement up. The volumes are dropping through the floor. It's not necessarily bearish, but what it is, it's managed. It's been put to sleep over the summer months, put into a coma. And, there's still the boys out there who want to make their end-of-year numbers. And that's probably the only game right now, is the end-of-year numbers, just like we saw last November. Those end-of-year numbers, if you thought you knew what the end-of-year number was on November 1st, you were way wrong, But, it would have been in November 1st, you thought it was the end of the world. But they found a way to pull success from the jaws of failure, And that's
how about the night of the election? First time I've seen S&Ps limit down in a long time. And normally as a trader, limit down, usually you have at least 1 day follow through, and pools used to build up, and that turned on a dime. Icon left the party, bought $1 billion worth of E-minis, at least that's the story. But you have to believe that, it's being gamed, because a limit down move or a limit up move, normally when I was coming up in the business, you'd usually see at least follow through for an hour or two the next day.
But you see, that's it. We've repeated that pattern over and over and over again in the last 8 or 9 months. That's the EKG I was telling you, where you get the spike and then you get the volatility getting sucked out of it. And it's over and over and over again. Some people say that, okay, when it goes to the downside, buy the dip. But this is not a classic buy the dip environment. You need to trend to buy the dip. And we really haven't had the trend. We've had shakeouts, these little V-shaped things. And the V-shaped things have sapped life from the market, because the volume just keeps on dropping, because there's a lot of people who've gotten washed out in this. There are a lot of trend followers have these big red bars, and they've sold at the worst prices, and so a lot of that volume has been sucked out. A lot of players have been taken out. And, it's easy for the longer term trend followers, very easy for the long term trend followers. That's where I'm making all my money this year, is on long term trends. I'm not, for me, the trading this year has just been scratches, because every time I get a big winner, I turn around and some piece of chaos comes and slaps you across the face, and I get a good chunk of that profit taken away from me. And I've worked for months on, well, how do I reduce or eliminate that chaos factor in order to protect when I'm making more? And I still don't have a perfect solution because the chaos comes just as easily to the stuff that's perfectly technically organized as to say more volatile markets like a momentum market like optoelectronics or some hot thing that's going up 20 and 30 points, down 20 or 30 points. This stuff's happening on Dow components where you get these ridiculous like big bars that don't mean anything, you know? But for technician, we're getting sucked out of it.
Yeah, you know, that makes me think about the little mini flash crashes we had in the precious metals last month, you know, where they took silver down $1, cleaned out every sell stop, and that ended up being the bottom. They did it in gold a few times.
At least that's more typical of the commodity markets. You expect the commodity markets are going to just punish the last suckers mercilessly before they turn, you know? They did with oil down to 40.
But not in 30 seconds.
Yeah.
You know what I mean, Alan? I mean, I've seen that, you know, my Twitter handle is Forex Stop Hunter, so I know that, you know, markets are always seeking out liquidity, buys and sell stops, but in my career, and it's probably as long as yours, I haven't seen it happen this fast in a matter of a minute.
Well, the speed of it too is because the human brain can't process it. Part of that speed is because not only the human brain can't process it, most people are very poor multitaskers. So if they're hit with multiple inputs in a very short period of time, they don't have time to process that information unless they have a very automatic system in place that knows exactly what to do and is going to react immediately if a price is hit, you know, or if there's some sort of momentum swing that sets off their signals. You know, at-home gamers, you know, and I use that term very derogatorily, you know, it's, for the most part, make money, and then there's some folks at home who've solved the riddle, but most of the time, most of us are feeding off the at-home gamers as opposed to, we're not feeding off algos, we have to feed off of somebody. So we're feeding off the people who are worse than we are. So, you know, a lot of times they can't, if this shit happens fast, excuse my language, if this happens really fast, they don't have the capacity to process it, so they make mistakes, of which if you have a system that's very fast and accurate and knows how to respond to that stuff, you can take advantage of that stuff very, very frequently.
Yeah, I mean, this overload of information takes me back to a book called Future Shock by Toffler. You know,
I read that. I read it.
Yeah, it's like we're living it now, don't you think, Alan?
Yeah, my concern is the algos have become so efficient in dealing with the small fry. They're not dealing with those of us who've been around for years because we could adapt and adjust. That the liquidity just keeps getting worse and worse and worse in the equity markets. I've seen, you'll go and see a stock that trades 2, 3, 4 million shares a day. In the first 15 minutes, it's got a $1.10 spread on it. We didn't see that when they sued the NASDAQ specialists back in the mid-90s for artificially wide spreads. It'll have like $1 spread.
And it was an eighth or a quarter then, and you know, before we went to decimalization and took the incentive out for open outcry for people to be there. So this structural thing, it's got to someday come home to roost, don't you think? I mean, I do think the system's going to break down at some point, and we've already. It's like anything, because I'm just a real believer in mean reversion. So it's not a bearish call. It's the fact that we've gone up for so long compared to the fundamentals of everything that, you know, I've got to stop and say this though, but the market's a perfect reflection of the economic environment right now. I mean, it is. All those years of QE, you know, have created this sort of zombie-like economy. I mean, Janet Yellen wants to know why wages aren't going up. Just have 2 kids who are in their late 20s, and they'll tell you why wages aren't going up. Employers don't give a crap about giving them wages. They're not trying to retain employees, even though they're short of employees, because they're into financial engineering like everyone else, and human resource is just another part of financial engineering. So they're not going to. The boss says no pay raises. They're not going to give pay raises, and then if they lose a 25% of their employees, they're just going to modify their business plan or some way to fit in with that. You know, so there is no sort of competing for employees that would create a rising wage environment, which is why you keep getting, well, the Fed, we see it coming, full employment. Yeah, but, you know, it's not the 1980s, it's not the 1990s. Human beings are no longer human resources. They're just entries in the spreadsheet right now as far as companies are concerned. Boy, I wish I had a time machine after listening to you for 20 minutes. So anyway, we're living in this brave new world, Alan, and you brought up the Fed. Do you really think they're going to move ahead with trimming their balance sheet in September and if we're having liquidity issues in the markets right now, do you think that's going to exacerbate it?
Well, they have a good record of not disturbing the market. Their big problem will come when the volatility gets away from them. They've been blessed by controlling volatility for so many years. All of their conceptions are based on volatility staying about as low as it is now. If the markets start to move, it's going to make it very hard for them to move that stuff economically and not have an impact on world markets. You know, that said, they're the ones who created the monster in the first place. There's a lot of people very angry at them because of that, you know, and we're still that monster's still sort of feeding on everything, and it got us out of the 2008 thing, but it also brought us into a depth of corruption in world politics that we haven't seen in 50 or 60 years. I mean, so the fallout from that in the non-market stuff that sort of feeds back to the market is still an untold story. You know, for us traders just trying to make a buck every day, you got to be so patient. I don't trade nearly as much as I did before. It's just so pointless. All my systems tell me to trade less and hold on longer during the trend in the trend following stuff, and to get in and out as fast as I possibly can on stuff that's not trend following. I know I lose more money waiting around than I do by being wrong.
Wow. The opportunity cost, you mean?
Opportunity cost, plus the longer you stick around, the greater the odds that something unexpected or non-technical is going to happen with your thing, because the algos know you're there. And so if there's any buildup of demand or supply on one side, they're going to go after it like sharks. And so as soon as you enter a position long or short, you become a member of a crowd. Hopefully your crowd is very, very small, but the longer you're sitting there, the bigger your crowd's going to get, probably, you know? So you want to get in there and get your money and get out. And the longer you stick around, I think Blake was talking about that. The longer the price holds a certain level, the more likely it's going to screw you. You know, if you're waiting for a short from off a high and it's not going down, then you know that's very dangerous. You want to sell short something and immediately be in a profit. That's really the only way to do it.
Do they have less control in things like the Russell, which you're showing here, and it's holding I believe that's a 200-day, but you know, I mean, divergence after divergence, rising wedge, whatever you want to call it.
We actually, the three I follow, which is SP 500, NASDAQ 100, and Russell 2000, which I use instead of the Dow, in a sort of a Dow theory kind of thing. They actually they've gone in and out of convergence this year. Last year they were in divergence the whole time. You know, one would be strong, one would be weak. There have been moments in the end of the second quarter, third quarter, where all three were convergently pointed to the upside, and I said, you know, that automatically, in my scheme, opens the possibility of a parabola. You know, that's what you see. That's what we saw in September 2008. We had a downside convergence, and 1 month later, we had a parabola. You know, the wrong way. So you know, I've seen it, and then it gets right to that point, and it just fades. And that's why you see, if you see the Russell chart that I have up now, I mean, there's no price rate of change since in 2007. You can talk about Russell all you want, but it hasn't. Is it down? It's just about down for the year, isn't it? Here's December, and here's where it is. Look at that.
Yeah, nothing.
It's nothing. It hasn't moved, and that's, you know, you could say that's not important, but that's all the market internals are buried in the Russell.
You know, as an old school guy, I would call this, instead of consolidation, distribution.
It could be distribution. I mean, if you want to, you could look at it from. Oh God, I gotta find my add a thing. I don't have my.
It's a great look, though.
I want to pull up the OBV on this, because that's my basic. If you read anything that I do, no, it's fine. In Investopedia, I'm crazy about OBV, but only in the daily time frame. It's got to be daily, or else I can't even read it.
Look at that.
Yeah,
all those false breakdowns. Yeah.
It's right at the same point. Is it a distribution top? You know what? You haven't seen the sellers, but you don't have the buyers. You could be the transfer of smart money to dumb money, and you wouldn't know it yet, because you're not going to know until it's over. You know, I'm a little wary about using OBV on the big funds. I mean, if you look at the divergence here, see that on the Qs? I don't think a SPY has that divergence, but I could be wrong. No, look, there's the SPY divergence. This is everybody complaining about low volume, because that's what it's going to do. When I complain about low volume, I go to the fund volume first and compare it with the average 60-day average volume, and that thing's been dropping like a rock for the last year, for the past 5 years. You know, some of it is buybacks, some of it is boredom, some of it is The fact that when algos aren't in the market and they're not active, there's no volume at all. All those low volume days are retail traders pushing stuff back and forth. The algos and the big whales aren't in the market on that day, on those days. So, you'll see a rally and then the S&P 500 does 55% of its average daily volume, and you go, well, the retail pushed it up. And that's been a very accurate way of looking at the market for the past few years.
Do you think the bond market could get away from central planners easier than the stock market because it's so huge? It's much larger, harder to control.
If we ever have an underlying theme that sticks with us for a long time, other than zombie growth, which is 2%, 2%, 2%. The
right.
bond market will it's just like commodities and gold. Bond markets will respond to the big stuff. If there's a sea change between risk instruments and risk-free instruments, then the bond market will, it benefits, but not enough to break. The channel, the TLT highs in the last last 6 years, right?
Yeah.
I mean, look at this.
Yeah.
It's just it's fooled every trend follower.
Right.
I mean, the guys who are buying here don't plan on selling here. They want to get in and stick with it for a few years. So every time it's made a new high, it's screwed breakout buyers over and over and over again. And this is another sort of a distribution pattern in this way, right? I mean, you can't really use the OBV on this, but this is saying, yeah, we're going to reward you, but it's such an overloved trade that the best we can do is pop a new high and then go back the other way and shake out. And that's what we've had since 2009. This is basically the QE chart right here. And the thing is, it's still contraction, just like every other market. I mean, you got endless contraction. Look, this hasn't done anything since 2013. But everybody talks about gold every day, but it hasn't done anything in 4 years. It's like, let's talk about something that's going somewhere. Hey, here's my idea of the day. This is going somewhere. This guy right here. See this? Literally one of my few favorite charts. Yeah, one of my few favorites. I have to probably put this on a weekly so I could do the fibs on it.
Okay.
Let me just show you this. And you can't really do this with XBI. I tried doing it. It's got a different chart.
Mm-hmm.
But there's a low right there, right? So you have the rally right to the breakouts here. Here's the cup and handle base, or whatever you want to call it. Here's the cup, here's the handle, here's the breakout, here it is coming down, and you see how the breakout's right on the 386.
Right.
Now, knowing my markets the way I do, I'd like to buy a 300. It's open trading at 309 this morning. Okay. Right. I mean, I'd like to buy it at 300, but more likely, I would love to buy it down here about 295. Because you just know it will, don't you? I think there's even an unfilled gap right here. Let's see. So, no, there's not really an unfilled gap, but see the 200-day moving average is slightly below. This trend line slightly below. The support is slightly below. To me, that's the kind of trades that really make it, because we're still this is still a bear thing here, because here we moved down to range support, then we broke range support. Now we've moved up to new resistance.
Yeah.
I want to see it take out all the real smart guys who who loaded up on biotech. Yeah. And that would be, for me, a position to hold for months to years. I think as long as it's very tight stop, it goes down here, you sell it, you just stop out. But the reward risk of that is very, very phenomenal. And if you don't want to buy the index, you got to buy the strongest components, which has it has risk in biotech because of the hot cold thing.
Yeah, they're wild.
Yeah. Look, Gilead, which was one of the best trades for decades, and now it's just a piece of garbage. So I mean, that to me is one of the few moving markets. The other thing, which if you follow me on Twitter, I'm very heavily loaded up on is the U.S. defense stocks. I bought Lockheed Martin when President-elect Trump attacked the company on Twitter. I bought Lockheed Martin that day, and I'm up 51 points on it.
Wow.
And then I bought Collins, which is the supplier to Boeing, because Boeing, which is really a defense stock now, it's not an airline company. They supply avionics systems to them, and now they're in merger discussions with United Technologies. That whole industry, because one thing you count on in a Republican administration is high defense budgets and a few good wars. So I mean, that's my Trump play. I'm not betting on a stronger economy. I'm betting on more war.
Maybe there aren't any, maybe we can't have good wars anymore.
Good wars, yeah. No more good wars. Only the more dangerous.
Apocalyptic type wars, yeah.
I figure it might be good for. You see, it's good because Lockheed is located in Baltimore, while Boeing is located in Seattle. So I figure, Lockheed might be a monopoly someday.
In Baltimore or Seattle?
No, Seattle, which is it's inside the concentric circle. You
that's right.
Where are you in the country? Where are you?
I'm in Temecula, California.
Yeah, well, I mean,
yeah.
it was pretty interesting here. Somebody could have done a screenplay on it as long as Hollywood was still there. Last week, it was people were wondering, well, what do I do? What do I do? Where's the concentric circles go?
Right.
That's still out there. Duck and cover was alive and well in this part of the country last week.
I remember that. Yeah. Alan, you want to show your website because I know it still exists. Blake wasn't sure.
But it's really only a placard or a placeholder now.
Okay.
So it sends people other places. So what I'd rather do is just send them right here, which is a good place to go. You see this?
Okay.
You see this a contributor, and you see this number here, which says I've done 638 articles.
Yeah.
I've actually done over 1,000, but the older ones are scrolling off. And
You're prolific.
I do cover just about everything. You name it, it's covered. So if you want analysis, like it's equities and some commodities, like top runners, first bull market in 4 years. That's a place to go. It's all 100% free, but this is a nice, good receptacle for my work. They'll be around longer than Hard Right Edge because they're really
okay. Okay, so you could follow Alan on Investopedia, and God, Alan, you covered a lot of ground in 25 minutes or so.
Yeah, and
I knew it was going to be great, man.
Please come and follow me. I'm active all day just because I'm bored. If you can handle my sense of humor, I promise you get some stuff on the markets.
All right, and I really wasn't trying to insult zonies that they couldn't handle a time change.
It's true.
I used to live by the point in time in Phoenix, so I spent my time in the desert too, and it really was a pleasure to hear your voice and really talk about structural issues and things that we're all struggling with in this new era, and really a kind of a vote of confidence for FX that it's a truer market. And
God, yes.
So that gives me some reinforcement that I'm at least teaching people in an arena that's the deck isn't stacked as much against them.
No, it's a very interesting market, and if I had gone that way originally, I may never have left it. Fortunately or unfortunately, I've always been tied to swing trading, and I can't really escape from it at this point.
Well, and I was telling Blake, you were at Larry Pesaveno's house at the bottom in October of 2002, and it's great to talk to veterans, like you and Larry and Blake, and because so many people coming into the business now didn't have the same advantages we did back then, where you could find like-minded people. They're all saturated with hype on the internet. And thanks for bringing a dose of sanity to F.A.C.E today.
Oh, I appreciate that. Thanks for having me.
All right, Alan, and good hunting the rest of the year. And perhaps we could do this again down the road without any technical difficulties.
You know my number. You know how to reach me.
I do, buddy. Okay, everyone, thank Alan Farley, and you know where to follow him now. And everyone have a great day, and we'll see everyone tomorrow. And most of all, don't just count your pips, count your blessings. See everyone tomorrow. Adios. Thank you, Alan.